Hello, it's John Burford, and this is the more advanced video on how to use Elliott wave theory in your trading. I'm going to show go back to the example of gold and show how Elliott waves work in very many time frames. In fact, gold is showing us pretty much a textbook example of how we can use the Elliott wave theory. If you remember from the first video, I used two of the main principles of Elliott wave theory. Number one is the observation that in a big bull market or even a bear market, the market will travel in 5 main waves. Once the 5th wave is finished, then we will get a 3-wave, an ABC correction. And then from that ABC correction, we'll get a resumption of the main trend. And of course, this can happen over very, very large time frames and even small ones. So let's get started here. This is the low of 2009. We had a big correction down here from the $1,000 area. It went down below the 800, around 700, something like that, if I remember. And from that point, it embarked on another wave. So let's count the waves. I think I can count wave 1. I've got an A, B, C correction to wave 2. I've got big waves up here. I can count that as a wave 3, which is long and strong. That's one of the requirements. Wave 3s are usually very powerful and usually just exhibit very high momentum readings at times. So that's wave 3. We've got an A, B, C wave to correct that. So that's wave 4, and the big exponential rise up here to the 1800 area could be wave 5. It could be wave 5. Now, I will tell you this, that 5th waves are usually very difficult to top out. In other words, to determine when they've actually finished rising, and to find a turning point. They're very tricky. We have clues from other areas, but from a pure Elliott wave standpoint, we often get what we call extensions of waves 5. And you see wave 5 already is way above the normal trading channel. If you consider this the big wave here as a trading channel, and if you refer to my tramline trading video, you'll see how we do that. Okay, so that's poked way above this trading area here. So there's an element of caution here for the bulls, I believe, because we have 5 waves completed on many wave counts. And so let's look at them. So that's the main wave count from 2009. That's a good 2.5 year period. So let's zoom in on the period from wave 4. So let's go down here and get a bit more fine detail. Here we go. So that's wave 4. That's wave 3. A, B, C. So as I mentioned in the earlier video, that you can use wave counts to time your entry into the market. This would be an excellent point around here to get long, of course. This is a wave C area, and we're in a bull market. I've identified that as wave 3. That's wave 4. So we're going to find a wave 5 emerging from here. At the end of wave 5, the market will reverse in at least an ABC pattern. So let's see if we can count the waves from here. I can count a wave 1. That's an A, B, C correction. So that's good. That's a wave, that's 1, 2, that's wave 2. Wave 3 is here. And this is a very complex area here. That will be wave 4 because we have an A, a B, and a C, if you see. Wave B lies beneath this wave 3, this is good. And wave C is on a par with wave A, so that's fine. So that's wave 3, that's wave 4. This exponential rise here will be wave 5. Now, as I say, We don't know when wave 5s end, especially when they are exponential like this. I've seen many examples of markets that just keep going and going and going until they stop. Then they plunge dramatically. It's a bubble, of course, and bubbles burst. The higher or the more inflated they get, the louder the bang. Okay, let's see if we can count on an even finer scale. Let's get down to the, I think the 2 hour, the 2 hour time frame will work. This is our wave 4, if you remember from last time. So let's count this as the low. From this point we've had a wave 1, a wave 2, a wave 3, a wave 4, and a final wave 5. That's pretty, isn't it? So even on this finer scale, from when is that? About the 2nd or 3rd of August. That's about a 10-day trading period. We've got another 5-wave pattern. 1, 2, 3, 4, 5. Very convincing. Now, what gives me the idea that this could well be the final top in gold? Well, one of the reasons is to look down at the momentum. I'll be covering momentum in another video, but what I'd like to see in the 5th wave of a 5-wave move is what I call a negative momentum divergence. So what we have here, we've got a big strong 3 with high momentum. Here's the momentum here. We've got the wave 4 falling down here, and then the rally in wave 5 only takes it, the momentum that is, to a point lower than wave 3, whereas the price made it higher. So we got a higher price but a lower momentum. That's a divergence, what we call a negative momentum divergence. That's a clue that the buying power is subsiding, and to look for a top. Okay, let's, on this time scale, we can examine the behavior of the market after this point here. We've got a wave 1 down there, which will be a wave A, a wave B, a wave C. And this wave C lies below the wave A. So right away, we have the condition for an ABC, a corrective pattern, fulfilled. That's very nice, isn't it? So the market, if it's still in a bull market and this 5th wave has not finished yet, for example, we could count that as wave 1, that could be wave 2, that could be wave 3, that could be wave 4, and we could go on to make another high in wave 5. That is certainly possible. The most likely scenario is given by the other factors. So, if that is indeed the top, what do I need to see to confirm the top? Well, there are several clues. Here's one of them. If I draw a line joining those lows there we go. We have a mini head and shoulders pattern here. Here's the left shoulder coming down to this neckline. We've got a rally up to the head. We've got to move down to the neckline. We've got the right shoulder here, and we've got an imminent break of the neckline. So I would like to see the market move down here next week. Now, by the time you see this video, of course, this will be very old history, but we all have to work in real time. So to confirm that top, I need to see that as a wave 1, that as a wave 2, and a big move down here in a wave 3. If I can see a strong move down, which would have the characteristics of a wave 3, which would put the momentum down at this level here, then that would give me confidence that I have detected the top. But as of now, it could go either way. Now, in terms of trading, what you could do, of course, is use your tram lines. from here to there, that's quite a good tram line, that point, those points, that point, and we had a break here. So that area there would be your short selling area. You'd sell there. Now, because the market has moved down quite sharply from that point, you'd be moving your stop loss down here to break even, using my break even rule or other rule that you may have. You must use money management at all times. Good rules like that 3% rule that I recommend. In fact, if you have a larger account, I would say 3% is far too big. I'd say 1% or less for each trade. That's the risk to your stop loss for each trade. Okay, there we have it. That's how I use Elliott wave theory in my trading. Now, I use it in conjunction, of course, with the tramline and the Fibonacci methods. So it's a complete picture, holistic picture, and that's what gives me the edge, I believe, in trading. But this is one very essential part of it, and I hope you've enjoyed the video, and see you in the next one.